Hi, welcome back. If you checked the price of silver or gold this week and felt a little confused about what you were looking at, you are not alone. After weeks of climbing higher, both metals pulled back, and a lot of everyday investors are asking the same question. Did something break? Is the rally over? Or is this just a normal pause before the next move? Today we are going to slow down and walk through exactly what happened, why a report most people have never heard of managed to move billions of dollars in the metals market, and what a realistic summer outlook actually looks like. No hype, no fear, just a clear explanation so you can make sense of your own portfolio. Let's start with the headline event. This past week, the government released the Producer Price Index, usually just called PPI. It is easy to skip past a report with a name like that, but this one matters more than most people realize. The Consumer Price Index, or CPI, tells you what prices look like for regular people buying groceries, gas, and everyday goods. PPI is different. It measures what it costs producers and businesses to make and sell those goods before they ever reach the store shelf. Think of it this way. CPI is the bill you get handed at checkout. PPI is the cost building up in the kitchen before your order even reaches the table. When that kitchen cost starts creeping higher, it often shows up on your bill a few months later. That is why traders watch PPI so closely. It is one of the earlier signals of where inflation might be heading next. Now, here is what actually happened. The headline PPI number came in flat for the month, which on the surface sounds calm and even a little reassuring, but when you strip out food and energy prices, which tend to swing around a lot, the core number came in a bit hotter than expected. So you had two signals pulling in opposite directions at the same time. The overall number looked cool, but the underlying pressure looked sticky. This came just one day after a separate report showed consumer inflation actually easing for a second straight month. So investors walked into Thursday feeling optimistic that the Federal Reserve had less reason to raise interest rates again. Then the PPI report landed and complicated that story a little. Gold and silver, which had been climbing on hopes of a friendlier Fed, gave back some of those gains almost immediately. Now this is important because gold and silver do not move on emotion. They move on expectations about interest rates, and interest rates are tied directly to what the Federal Reserve is likely to do next. Here is the simple version of that relationship. Gold and silver do not pay you interest. They just sit there and hold value. So when interest rates are high, investors can earn a decent return by putting their money into bonds or savings accounts instead. That makes metals less attractive by comparison. But when interest rates are low or expected to fall, that advantage disappears and money tends to flow back into gold and silver because there is less opportunity cost to holding them. So anytime a report changes the odds of a rate move, even slightly, you will usually see gold and silver react within minutes. Right before this PPI report, the market had priced in a meaningful chance of a rate move at the Fed's September meeting. After the data came in mixed, those odds shifted lower. A cooler path for interest rates should in theory be good news for metals over time, but short-term uncertainty itself creates volatility. Traders do not like split signals. They like clarity. And when the data does not give them a clean answer, you often see a knee-jerk pullback first, followed by a period of consolidation, while everyone waits for the next piece of the puzzle. That is largely what we are seeing in gold and silver right now. Let's break this down further, because there is more going on here than just one economic report. Silver, in particular, has had an extraordinary run over the past year. We are talking about a level of appreciation that is unusual, even by silver's historically volatile standards. When any asset moves that fast, healthy pullbacks are not just common, they are expected. Think about it this way. If a stock or a commodity climbs sharply without ever pausing, that is often a warning sign, not a strength. A market that occasionally cools off, shakes out short-term traders, and then stabilizes tends to be healthier over the long run than one that just goes straight up in a straight line. So a pullback after a report like this is not necessarily a signal that something is wrong with silver's bigger story. It may simply be the market catching its breath. Now let's talk about what is actually still supporting these metals underneath the daily headlines, because that longer-term picture has not really changed. Silver is not just a store of value the way gold is. It is also an industrial metal. It gets used in solar panels, electric vehicles, electronics, and increasingly in the infrastructure being built out for artificial intelligence and data centers. Industry groups tracking the silver market have continued to project a global supply deficit again this year, meaning the world is expected to use more silver than gets mined and recycled. That kind of structural imbalance does not resolve itself in a week or a month. It is a slower-moving story that plays out over years, and pullbacks driven by a single economic report do not really change that underlying dynamic. Gold's story right now is a little different, and it is worth understanding separately from silver. Central banks around the world have continued to be active buyers of gold, treating it as a way to diversify away from holding too much of any single currency. At the same time, there is ongoing geopolitical tension tied to shipping routes in the Middle East, along with negotiations between major powers that have not been fully resolved. These kinds of tensions tend to put a floor under gold prices because investors often view gold as a place to park money when the geopolitical picture feels uncertain. So even on days when gold pulls back on interest rate expectations, that geopolitical support has not disappeared. It is running in the background the entire time. If you are finding this helpful in making sense of what is actually driving these swings, go ahead and hit like on this video, and if you have not already, consider subscribing to the channel. It genuinely helps this content reach more people who are trying to understand their money and their investments a little better, and I will keep making videos like this one to help you do exactly that. Let's talk about what a realistic summer outlook might look like. And I want to be upfront that nobody can predict short-term price movements with certainty. Anyone who tells you they know exactly where gold or silver will be in 30 days is guessing, even if they sound confident. What we can do instead is look at the forces in play and think through a few reasonable scenarios. In one scenario, upcoming inflation and employment data continues to come in mixed, similar to what we just saw with PPI and CPI pulling in different directions. In that case, you would likely see continued choppiness. Metals might trade in a range, bouncing between support and resistance levels as traders wait for a clearer signal from the Federal Reserve. This kind of sideways, choppy action can actually be normal and even healthy after a big run higher. In a second scenario, upcoming data continues to show inflation cooling meaningfully, and the job market keeps softening the way it has recently. In that case, the odds of a rate cut later this year would likely increase, and historically that kind of environment has been supportive for both gold and silver, since lower rates reduce the appeal of holding cash and bonds compared to metals. This would not guarantee a straight line higher, but the underlying wind would be blowing in a more favorable direction. In a third scenario, geopolitical tensions in the Middle East escalate further, particularly around shipping routes that matter for global oil and trade. If that happens, you could see a flight to safety that lifts gold specifically, even if interest rate expectations stay the same. Silver tends to be a little more sensitive to industrial demand concerns in that kind of scenario, since supply chain disruptions can cut both ways, sometimes boosting silver as a safe haven and sometimes weighing on it if investors worry about a broader economic slowdown. None of these three scenarios is guaranteed, and the real path forward will probably borrow a little from each of them depending on how the next several weeks of economic data and geopolitical headlines unfold. Here's what this means for you as someone watching your own portfolio or savings. Short-term price swings like the one we just saw after PPI are honestly part of the normal texture of these markets. They are not something to panic about, And they are also not something to celebrate wildly if prices happen to move in your favor on a random Thursday. What actually matters more is your own time horizon and what role, if any, precious metals play in your broader financial picture. Someone who is holding metals as a long-term store of value is going to experience these weekly headlines very differently than someone trying to trade short-term price swings for quick profits. Neither approach is automatically right or wrong, but they do require very different mindsets, and it helps to be honest with yourself about which one you are actually doing. I also want to acknowledge the other side of this conversation, because it is only fair. Some analysts believe that after such a dramatic run higher over the past year, silver and gold are due for a more extended cooling-off period, not just a one-day dip. Valuations by some historical measures look stretched, and if the Federal Reserve ends up holding interest rates steady for longer than the market currently expects, that could remove some of the tailwind that has been pushing metals higher. It is worth taking that perspective seriously, rather than assuming the only path forward is up. Markets rarely move in one direction forever, and precious metals are no exception to that rule. A simple mental framework that might help you going forward is to separate the noise from the signal. The noise is daily headlines like this week's PPI report, individual data points that move prices by 1% or 2% in either direction within hours. The signal is the slower-moving structural stuff, things like ongoing supply deficits in silver, central bank buying patterns in gold, the broader direction of interest rates over months rather than days, and geopolitical trends that develop over quarters, not single news cycles. When you catch yourself reacting emotionally to a single day's price movement, it can help to ask whether anything about the signal actually changed or whether you are just responding to noise. Most of the time, a report like this week's PPI print is noise layered on top of a signal that has not meaningfully shifted. It can also help to write down in your own words why you originally decided to hold gold or silver in the first place. If your reason was long-term, something like protecting purchasing power over many years, or simply diversifying beyond stocks and cash, then a single week of price movement in either direction does not really change that original reasoning. If your reason was short-term trading, then a different set of rules applies, and you probably already know that short-term trading requires much closer attention to daily data than long-term holding ever does. Let's also talk briefly about how this connects to your actual, real-life financial decisions, because that is ultimately what matters here. If you already hold gold or silver either physically or through an investment account, short-term dips like this are simply part of the ride. Trying to perfectly time entries and exits around every economic report is extremely difficult, even for professional traders who do this full-time. If you are considering precious metals for the first time, moments of pullback are often when people start paying closer attention, and that is a reasonable instinct, but it is worth doing your own research and understanding your own goals, rather than reacting purely to a single week's price action, either up or down. Looking ahead, keep an eye on a few things without letting any single data point become the whole story. Watch how the Federal Reserve communicates about its plans for the rest of the year, since their words often move markets as much as their actual rate decisions do. Watch upcoming inflation reports, both CPI and PPI, since the market clearly reacted to that mixed signal this week and will likely keep doing so with future releases. And keep half an eye on the geopolitical situation, particularly anything involving shipping routes and trade negotiations, since that has been quietly supporting gold even during pullback days like this one. To bring this all together, gold and silver pulled back this week after a producer price index report sent mixed signals about where inflation is heading next. The headline number looked calm, but the underlying core reading came in a bit firmer than expected, which complicated hopes for a near-term rate cut from the Federal Reserve. That kind of uncertainty tends to create short-term volatility in metals, since gold and silver are highly sensitive to changes in interest rate expectations. But the bigger structural forces supporting both metals, things like silver's ongoing supply deficit and industrial demand growth, along with continued central bank buying and geopolitical tension supporting gold, have not gone away because of one economic report. As we move through the rest of summer, expect more choppiness tied to upcoming data releases, but try to view each individual headline as one data point within a much longer story rather than the whole story itself. If this video helped you understand what actually moved the market this week, that is exactly the goal here, breaking down complex financial news into something clear and useful without the hype or the fear-mongering that so much financial content leans on. Thanks for spending this time with me. I will see you in the next one.